Hi, I'm Braden Warwick, Financial Planning Product Architect at PWL Capital. Today I'm going to walk through my retirement planning tool. Whether you're brand new to retirement planning, you're a DIY investor looking to fine-tune your retirement plan, or you're an advisor looking to implement advanced retirement planning strategies for your client, this video has something for everybody, so stay tuned. All right, so first I'm going to bring us to the landing page where you can take a look at our retirement planning tool, but also some of the other tools that we have for free available on our website, like our CPP tool or rent versus buy tool, for example. You can also check out who built the tool and check out other social media accounts for more content based around these tools. But today we're going to dive into the retirement planning tool, so let's go there now. So once you click into the retirement planning tool, you'll see something like this. And I'm going to walk through the tool from the top down. So of course, you can access other areas of our website up top. You can click the link to meet with us, or if you're a client, you can access your wealth center or portfolio up top. You can also change the view over to dark mode if that suits your preference. And same concept with your language. If you'd prefer French, you can change the language here as well. You can also click this question mark icon and it will show the description of the tool. So for a high-level overview, this might be a good place to start. If you're sharing it with someone new, you can refer them here so that they can get a sense of what strategies the tool is looking at for the retirement plan. All right. So that brings us to these three KPIs up top. The first one on the top left is the after-tax net worth of the retirement plan using the best strategy. And these subsequent KPIs are really highlighting the value of the retirement plan and specifically these decisions of which accounts to prioritize contributions to and to prioritize withdrawals from. So in the case of a TFSA versus RSP contribution decision, that one single decision can add over $1.3 million of value to the retirement plan in today's dollars. Similarly with the withdrawal strategies, it can add over $200,000 of value in today's dollars. All right, so let's go down to the charts. So we'll see we have 4 tabs here. We've got the growth of wealth, cash flows, tax breakdown, and comparison of strategies. I just want to mention that all of these outcomes are in today's dollars. So inflation's already been accounted for, but it's been displayed in real dollars so that it's a little bit easier to wrap your head around. All right, so starting with the growth of wealth chart, this chart by default will show the optimal contribution and optimal withdrawal strategy. You can see them here. They have the star icon beside them. And you can easily flip to the other strategy and it will immediately pull up the results for that strategy. So for example, in this case, the suboptimal strategy is to contribute into your RSP first. And you can see in this case, the RSP account growing substantially. But if we flip back to the optimal case, which in this case happens to be the TFSA, we can see both the RSP and TFSA growing, and that's based on the savings rate. Obviously, the TFSA is going to have a smaller contribution limit than the RSP is going to. All right, so that's the growth of wealth. The other KPI in here is just the real expected return, which is going to be driven by your expected return assumptions of the portfolio, which we'll get to in a little while. All right, moving on to the cash flows chart. So this will show the year-over-year cash flows for each case. Again, it will defer by default to the optimal strategies for both contributions and withdrawals. And you can hover over each year of the chart and you can get a sense of the income breakdown. So T4 income, CPP, OAS, and then your contributions and withdrawals from each account, along with taxes, deductions, and finally your net spend. So you can see what that looks like during working years here, and then you can see retirement has a different set of income. In this case, the optimal strategy is to actually withdraw from your RSP during that time period after retirement, but before CPP benefits kick in, which again, we'll get to the CPP discussion in a little bit, but in this case, we're taking CPP benefits at 70, retiring at 65, supplementing income with RSP withdrawals during that 5-year time period, and then withdrawing from taxable account first after that. All right, and if you want a more detailed view of income and taxes, you can go over to the tax breakdown, and this will allow you to change the contribution strategy, the withdrawal strategy, but also the year, so you can get a really detailed year-over-year view of what everything will look like. So by default, it's going to start with the current year, and it's going to show the $85,000 of income, and that can be adjusted in the assumptions tab, which we'll get to in a minute. You can also see any investment income, withdrawals, and then a quick tax breakdown, the taxes owed, CPP EI contributions, pension contributions, registered account contributions, and taxable contributions. And then finally gives you your net spend. All right, so the last tab is the strategy comparison tab, and it really allows you to get a visual of how these strategies compare against each other. And this information is what's feeding the KPIs up top. So remember, we talked about the contribution decision having $1.3 million of value, and that's really just coming from here. So if we look at the final net worth in both cases, we see in the TFSA first case, we end up with $4.5 million, which again is showing up here. And then the difference between the 4.5 and the 3.2, which is the RSP case, is 1.373, which shows up as that delta here. So it's really just about quantifying the difference between the strategies and showing the importance of these strategies for people, showing the value of financial planning. So you can look at the contribution decision, the withdrawal decision, you can look at that separately. We have more withdrawal strategies to consider, like the one that ended up being optimal in this case is kind of a combination of two, where you're prioritizing RSP in that window before CPP benefits kick in, and then once CPP benefits kick in, you're prioritizing a taxable account. And the reason why this is optimal in this case is because you're smoothing that taxable income out over those years. And then finally, you can choose a best versus worst, which takes the best of both decisions, the contribution and the withdrawal decision, and then compares that to the case with the worst outcome in each case, and it shows that true value of the plan, which is over $1.3 million. All right, so this is all the planning outputs. So just a couple key points to remember: all of this is in real dollars, so inflation has been accounted for, but it's kept in today's dollars, and you can really see that clearly in the cash flows chart because you see spending is constant over time. And the one thing to note is that this compare strategies chart is in after-tax dollars, so that you're comparing the after-tax growth of wealth in both cases. And that's in contrast to the growth of wealth chart, which just shows pre-tax account values over time. All right, moving on to the assumptions now. So this is where you can really customize the retirement plan to suit your situation. So I'll go through this in pretty good detail now. So starting with province, pretty straightforward. Choose your province of residence, and that will change the tax rates accordingly. Birth date, so you can either enter the text directly into this field, or you can click on this calendar icon and choose it in the calendar, whichever you prefer. The birth date will inform the age, so you don't need to type in anything here, but it will just kind of give you a sanity check to make sure that you entered the birth date information correctly, and it's kind of just a nice quick point of reference, especially for us building content around this tool. It's really easy to see what that person's age is, because that can potentially have a big impact on these decisions. Similarly with retirement date, you can change the date directly in the text field or the calendar icon, and that will automatically generate the retirement age. So it just gives a quick easy check of, okay, of what the person's age is and when they're retiring. All right, moving on to income. So this is representative of employment income, T4 income, not investment income. So you can either enter it in directly into this field. So I could enter 100K, for example, and it would change the entire income moving forward. So we now see income in this chart as 100K. I'll drop that down back to what it was. And then you can, but alternatively, you could do a much deeper analysis if you want to by clicking on that edit icon beside the text field. And now you can actually enter in any income for any year that you want. So maybe you're only working part-time next year and you have a lower income in that year. You can edit that and you can drag and drop this chart, or you can enter this field directly in the table. You can drag and drop this table. Maybe you're part-time for the next 3 years, and you can really customize this however you want. So pretty flexible there. Now note, it does change this text field. This text field is going to show the average income over the years. But if you edit this text field, it will apply that same income level to every year moving forward. So that's the difference. Spending is the same idea. So this is after taxes, after savings, net spending. And you can take the same approach. We could change this field here directly, and it will apply that same spend to every year. Or you can really get detailed with this year-over-year spend. The only difference between the spending pop-up and the income pop-up is that income is going to populate years up until the retirement date. The spending table will show spending for the entire life expectancy. So by default, we're assuming the same level of spending pre and post-retirement to have essentially the same quality of life pre and post-retirement. But of course, you can change that depending on how you see fit. All right, so that wraps up the general section. Okay, moving on to investment accounts. Pretty straightforward here. Current value of your TFSA. How much TFSA contribution room do you currently have? The current value of your RSP. How much RSP contribution room do you currently have? And then taxable account value and taxable account book value. Pretty straightforward there. Moving on to CPP. So CPP actually uses our CPP tool under the hood. And if you haven't checked that out, you can easily access it here. It'll give a much more detailed breakdown of what CPP will look like for you based on your earnings, based on any children you have, and any time periods that you're disabled. It will show the total present value of CPP, and it'll compare the value of CPP. But going back to our retirement planning tool will take the optimal CPP age by default. So in this case, the optimal CPP age is age 70, and that's what we see populated under the CPP tab here, is that optimally it's best to take CPP at age 70 for this individual. So that's what it uses. But what's really important is that you enter your information correctly, and particularly your past income. Now, just a reminder, this individual is 18, so there's not a lot of past income. There's just whatever income from the year 2024, last year, when they turned 18. But it's important for most people using this tool. They'll have some sort of income history that they'll have to account for. By default, this chart is going to show, it's going to pre-populate with the YMPE value for each year, which, if you don't know, that's just the year's maximal pensionable earnings, which in simple terms means that the tool is going to assume that you've made maximum CPP contributions in each year by default. So if you haven't, you'll need to go into this table and edit that. And you could you could approximate that. You could, you could take half of this value if you think you've made half of the contributions. It can be as detailed as you want it to be. And obviously the more detailed, the more accurate the outcome is going to be for you. You can also enter in number of children you have and any time periods that you're on disability, and that will factor in to the benefit calculation. And again, you can refer to the CPP tool for a much better visual of how all of that unfolds and what that means for your CPP benefit. But just note, for the purpose of this tool, you will need to enter in that information if you want an accurate CPP benefit estimation. All right, one final note on CPP. By default, it's going to choose the optimal year. You can also choose to enter in a custom year, and you can really see this in the cash flows chart. So by default, the optimal year is 70, but if we're selecting a custom year of, say, age 65, you can see the cash flows will change and now apply the CPP benefit earlier. So now the CPP benefit's kicking in at age 65 as opposed to 70, and that will obviously change the outcome. I do recommend leaving it as optimal. That's probably the best bet for most people. All right, moving along to OAS. So OAS is much more simple in terms of data entry. All you need to be aware of is the number of years you've been living in Canada after age 18 and before receiving OAS, and the maximum here is 40. If you've been in Canada for 40 years or more after age 18, then you won't have to worry about any OAS clawbacks due to that. But if you've been in Canada for less than that, it will claw back the benefit accordingly. So just be mindful of that. And then you can also enter the age at which to receive OAS benefits. By default, it's at 65, but you can also defer that up until age 70. All right, moving on to a defined benefit pension. So for those of you that are receiving a defined benefit pension, you can enter in your contributions here, and this contributions is the annual employee contribution. The next field is for the benefit, so that it's the projected benefit, and it's the monthly income received from the pension in today's dollars. You need to enter in the start date of the pension and the index rate of the pension. So by default, a 0 index rate is going to index it to inflation. And we'll talk about inflation assumptions down here, but if you know that your pension is not indexed to inflation, then you need to account for that here. And then the pension adjustment. So the pension adjustment actually decreases the amount of RSP contribution room that you generate moving forward, and that so that needs to be captured here. So what you need to enter is your 2024 pension adjustment, so last year's pension adjustment found in box 52 of your T4 slip or 034 of your T4A slip, depending. And you also need to enter in the income from that same tax slips. And what the tool does is it calculates the ratio of the pension adjustment to the income, and then it applies that same ratio moving forward. So that way, if your income is adjusting up or down in future years, it'll calculate that same pension adjustment based on that ratio. All right, that's DB pension. All right, moving on to life expectancy. So the source for our life expectancy data comes from FP Canada. And I'm just going to quickly pull up the link. If we jump back over to the CPP tool for a second, click on this question icon. There's a link here that links to the probability of survival table from FP Canada. So we can actually jump right into it. So this is the table that it's using to reference all of what the life expectancy should be, and it's dependent on your current age, gender, and what probability percentage you want to use. Now FP Canada recommends the 25% value, and that's what we're using in the tool. For more information on their methodology, I encourage you to read this paper, but we're using their assumptions. Okay, so moving back to our retirement tool, we can go back into life expectancy for a second. So we'll see it's the same inputs that's required to read the table. So we need the gender, we need survival percentile. Like I said, FP Canada recommends 25%, so that's what we're using. You can change that if you feel otherwise. And from the table, that that creates a life expectancy of 95, which is what the tool uses. Now, if you want to enter in your own custom life expectancy, you can also do that. You could crank this way down if you wanted to, and the tool will show you a warning here. It's saying that the life expectancy that you've entered is less than FP Canada guidelines. So it's up to you and your discretion of what you want to use here. But I would recommend sticking with FP Canada guidelines unless you really have a compelling argument against doing so. All right, moving on to expected returns. So by default, our expected returns are populated based on PWL Capital's financial planning assumptions, given the asset mix. So by default, it's 100% equities, but you could easily change that to an 80-20, and you can see the impact on the financial plan. You could change it to a 60-40. Whatever asset mix suits your risk profile should be what you use in this field. And it pre-populates here. Now you can change these values if you deem that's appropriate. For most people, I would really recommend just sticking with our default assumptions based on your asset mix. So now, last but not least, is the outcome field. By default, it's the expected outcome, which is the expected return of the portfolio. But you can change this to check to see how your retirement plan performs under bad circumstances. So let's take a look at that now. There's 5 options here, ranging from amazing, which is 2 standard deviations above the mean, great, which is 1 standard deviation above the mean, expected, which is the mean, bad, which is a standard deviation below the mean, and terrible, which is 2 standard deviations below the mean. So if we want to look at the terrible outcome, we can see that we're actually still okay. And you could actually make the argument in this case where we could potentially be over saving. So we can really use this if we don't know what our spending should be, but we want to set our spending level so that we're saving enough that we can be okay even when times are bad. So in this case, I think, like I mentioned, you could make the case that we're over saving, so we could bump up spending a little bit just to see what happens. In this case, we're still okay. We could maybe even go a little bit higher. Okay, so this is good. We're out of money here, and remember, we're on the terrible outcome, so we're 2 standard deviations below the mean. And to put that in terms of an expected outcome, there's about a 3% chance that this outcome or worse will occur. So if you can live with that, then that seems like a reasonable spending level for you. So we see we run out of money in 2095. So we're in our mid-90s when we run out of money. But let's just see what the actual impact in terms of spending is in this case. So remember, in this particular case, we have a large amount of retirement income coming from OAS and CPP, which are guaranteed. So those aren't impacted by the performance of your portfolio. So that we see here spending is $56,000 while we still have money in our portfolio. But then once our portfolio drops off, spending only goes down to roughly $47,000 a year. So again, if you can stomach that potential drop off of spending from 56 to about $46,000, so losing about $10,000 of income from your portfolio if it happens to run out of money, then that seems like a reasonable plan. But of course, this is going to change for everybody. In this particular case, or in the case of somebody that has a higher spending rate, they may not be willing to stomach that large of a drop in spending because OAS and CPP are only going to capture so much. All right, so now that we've solved for the spending rate, we know which withdrawal and contribution strategies are optimal for us. We can go and we can save this link. So in the top right beside assumptions, there's a link icon. You can click that and it will open this pop-up. You can copy this link and then you can go ahead and paste that over here into a new tab, and you can revisit that same scenario whenever you want. So you can bookmark this tab. If you're an advisor, you can send this link to a client. Really so many options to revisit the same projection that you did for yourself. All right, so that brings us to the end of our retirement planning tutorial. I really hope that you got something out of it. Please feel free to reach out on Twitter, LinkedIn, or TikTok. I'm trying to make content around these tools to share my insights that I've gained while building them. Thanks so much for watching. Cheers.